It is Walgreens Boots Alliance, WBA on this one. This one is actually down this year about, let's say, 6% or so, sitting at about a $30 billion market cap on WBA, okay? Not a super complicated one. It's a dirt cheap company. I know the company very well. I used to work for Walgreens many years ago, okay? I worked for Walgreens for probably, oh gosh, what was that, 2.5 years or so. Walgreens, 6% dividend yield on this one, forward P of under 8. It's a dirt cheap company. I mean, insanely dirt cheap. They have their full year EPS, they're doing full year EPS guidance of 445 to 465. So, I mean, when I look at this business, I just see a stable, great company that is going to throw off insane cash flow, insane net income, and be able to pay out huge dividends, and in future years, hopefully even up the dividends bigger than what I'm getting right now. So let's say, let's say right now I'm buying the stock, right? I'm getting a 6% yield. Well, if they up that dividend and continue to up that dividend over the next few years, you got to understand the yield I'll be getting on the shares I bought could end up being 8% yield, 10% yield, 12% yield, okay? Paid out to me each and every year. That's a beautiful thing. Now, obviously, if they do a bad job running their business, they could cut the dividend and the dividend could get smaller. That's certainly a scenario. That's not the scenario I believe is going to happen with this company. I believe they're actually going to expand their net income quite substantially over this next few years and be in a better position to continue to up that dividend more and more and more. And so I'm getting a 6% yield now, which is sweet, but I could be getting an 8%, 10%, 12%, whatever, 14% yield in the future. Remember, there's shares that Warren Buffett bought a Coca-Cola, decades ago, that I think he's getting something like an 80% or 100% dividend yield on now, because he bought those shares so low, and based upon the price, Coca-Cola pays out in terms of dividends nowadays, it's insane. And so just do keep in mind, like when you own stocks for years and years and they keep up in that dividend, like the yield you're getting on your shares are actually exponentially more, okay? And when I look at the management team led by obviously Roz Brewer, I sleep well at night. Let's just put it that way. I have no, I listen to that conference call and I'm just like, they're in charge. They got that show on lockdown, and I don't have to worry about that one. There's other companies I own that I definitely have to worry about and stress over. Walgreens is not one of those companies. And, I know they got canceled on Twitter about a couple weeks ago. I mean, I don't even remember them even talking about that on the conference call. It's just such a non-issue. So where do I see the most opportunities in this market? I don't see the best opportunities in the market necessarily being, the Apples and the Microsofts and many of those stocks. Although I'm not going to say those are bad investments, right? I'm sure you can make money over the next few years. But I think when you dive a layer or two deeper, that's when you really start to find real opportunities in the market, like much better risk-reward profiles, in my opinion, if you're a longer-term investor. I'm not talking for the next 3 to 5 months or the next 3 to 5 weeks. I'm talking the next 3 to 5 years. Much better risk reward profiles. And so that's the interesting thing in this market. You have a lot of stocks that are doing well at the very, very top, but beneath that, a lot of stocks are still just tremendous opportunities. Small caps continue to be phenomenal values out there across small cap land. Mid caps continue to be great values. And I think in order to get those smalls and those mids to get moving more, I think the one thing that's needed, in my opinion, certainty. More certainty before people really start to dive into those ones more. People don't mind, even in an uncertain market, putting money in Apple and Microsoft and some of those big dogs, right? But if you're talking about the smaller companies, that needs more certainty about what's going on with inflation, what's going on with the Fed, what's going on with the economy. As you can begin to, inflation become less of worries, the Fed raising becomes less of they're not raising anymore. If anything, they're getting closer to cutting, right? If you can start putting those pieces together, then those smalls and those mids can start to branch out, and those ones will start to obviously move up in a pretty significant way. That's when you start to really get back into a full bull market at that point in time. Just because a few stocks at the top are doing well, it doesn't mean you're on a bull market. For a true bull market to happen, you need the whole movement. You need the whole tree to be growing, okay? Not just one branch off the tree. You need 100 branches to grow off the tree. And I feel like right now we got like 1 or 2 branches that are really growing on the tree, and everything else is kind of still just waiting and seeing what's going to happen here. It is Estow. Planning on buying some Estow in the month of April 2023 here. Okay, so 3x, it's basically a 3x leverage against the Dow Jones Industrial Average. And this is a hedge for me, essentially. So it's basically a way I can hedge my portfolio. So if the market tanks for any reason, let's say over the next few months, next 3 months, 6 months, 9 months, something like that, I can obviously make money on this, and quite a substantial amount of money, especially if the Dow Jones Industrial Average was, let's say, go down in a pretty short amount of time and do it very, very quickly. That would be a pretty immense move. Now, in terms of SDAO, it's not always a perfect correlation between a 3x of whatever the Dow Jones Industrial Average. Sometimes it's better than that. Sometimes it's worse than that. It all depends on many various factors, okay, in terms of how that works. No, there's an insane divergence that's basically going on this year between the NASDAQ and the Dow Jones Industrial Average. And the NASDAQ's having a great year, okay, having a great year this year. Well, the Dow Jones Industrial Average is actually down this year. And this is an interesting divergence, and this is, for anybody that follows my channel knows I called this out essentially at the end of 2022, and I said, like, this is not going to last. There's been a huge divergence between these, and at the end of the day, like, the NASDAQ going to end up way outperforming the Dow, and it's exactly what's happened. And the reason I had so much conviction to make a call like that is what happened last year was so unnatural. There was a huge divergence between the Dow Jones Industrial Average and the NASDAQ. Such an insane amount. I mean, we're talking about over 20 plus percentage points. That never happens. I mean, usually you're looking at a 3 to 7 percentage point difference in divergence between the Dow Jones Industrial Average and the NASDAQ. And so to see a 20 plus percentage, I mean, this was like 25 percentage points at one point. It was so unnatural, folks. That doesn't happen. And so at the end of the day, I looked at it and I said, okay, a lot of Dow stocks have been hiding out money. I think a lot of those stocks are overvalued, and this divergence cannot continue. They're going to start to correlate more in line, and sure enough, that's what's happened here now at this point in time, okay? Now, if, let's say, hypothetically, the market was to tank, okay? Let's say over the next 6 months, okay, everybody freaks out again. Let's say, I don't know, inflation's way stickier than people have thought, and then they're afraid of the Fed, and they're afraid of recession, whatever, okay? So let's just say the market tanks, okay? What I could tell you will happen in that scenario is the NASDAQ will fall, and the NASDAQ will go down to just a slight gainer for the year. But what will happen to the Dow is the Dow will fall 10 to 20%, okay? And it will be negative 10 to 20% on the year. If there was a scenario where the market tanked, let's say over the next 6 months in a hypothetical situation, well, the NASDAQ will still likely be up for the year, okay? So that's an interesting kind of thing that could happen definitely in the market this year that I see playing out. And so SDAO, a nice hedge for me. You know, do you need to have a hedge on if you're a newer investor to the market? Probably not. I didn't have a hedge on for a long time. At this point in time, my portfolios are obviously, you know, pretty large in size and whatnot, and so I like to hedge a little bit now at this point in time, okay? Especially in uncertain times, like obviously we're going through, and we're going to have to see what happens with the economy and whatnot, just in case, you know, just in case the stuff hits the fan, as they say. What I do with an SDAO, in call options on SDAO and stuff like that, is if we had any sort of major tank in the market, whenever that would be transpiring, that's when I'd be looking to basically reposition out of those, take profits on those, and then reposition into longs at that point in time. And then I would go ahead and basically re-hedge at the very end of this year, essentially. So let's say hypothetically over the summer, market's tanking, it's getting ugly, okay? At that point in time, I go ahead and take all those profits, go ahead and funnel it into long positions at likely very low prices, let's say, right in the summertime or in the fall time or something like that, and then go ahead and re-hedge. Doesn't mean I'll re-hedge back into SDAO. It could be something different at that point in time, but that would be at the end of the year at that point in time if I was to do something like that, okay? And so just to kind of run you through my thought process on how all that works, okay?